And you're back with Wells Fargo. We were talking about before the break about the market this past week, talking about the technical situation. I want to go back, Brian, a little bit and talk about the head and shoulders pattern that was violated, because I don't think I gave anybody a downside target on that particular move. On the Dow, if you look at the Dow Jones Industrial Average, which most of our listeners, that's what they look at. The target on this violation is we're currently, 11,444. The target would be somewhere another 700 points lower, somewhere around 10.7 or so.
10.7.
So, at the break, we were talking about, a lot of folks right here are down 10% or so. Go ahead and pull the trigger and get out. It's better to be down 10% than down 50% or 20%.
Yeah, in the next few days, especially with the credit downgrade. Good heavens.
But here's what's likely to happen. We're so deeply oversold. I can see a bit of a rally phase coming here. Typically, those retracements will, from the Dow, we're sitting here at 11,444, probably take us up anywhere between 30 to 60% of this downtrend, so that would put us somewhere between 12,000, maybe 12,200, and then another down phase, which may complete the head and shoulders pattern down to 11,700. So I don't think that this market decline is over yet. I haven't seen the signs of a capitulation. But again, as I said in the first segment, I don't think this is the beginning of the major bear market phase either. I think we still have time in here, but I don't know how much time.
We talk about also, in addition to all this technical analysis, and of course you got fundamentals, but there's something that's not mentioned enough, Doug, and that's that psychology. You know how we talk about the psychology in our class and give people the diagram on the psychology, and they go, that is me, that is me. Wall Street really did it this time. They had everything. Once this debt deal's done, we're going to grow. We're going to grow. That just inundated the news.
Everybody
Fox, Kramer, doesn't matter who it is. Everybody thought once this debt deal's done, it's going to take off. And it got in the psyche of people that even knew better.
Brian, I admit, me too.
Me too, a little bit.
I swallowed it hook, line, and sinker. I just knew that when the debt deal got done, the market was going to rally.
It popped me a little bit. This whole thing, it got me in my own trading.
And hey, it did rally for about 2 minutes. And then, look out.
Oh, yeah.
It rolled over and...
Talk about volatile. But the thing is, that psyche, they got into our psyche, had the country believing this thing was going to take off after the debt cycle. Everybody was buying or holding their position. And then, bam, they took the rug right out from under us. If that wasn't... That's about as... obvious as it gets. I don't know how else to put it, because you can go back in history, and they've done this in the past, too, just prior to the big bank failures. Remember when Kramer had the Wachovia guy on?
Oh, yeah.
He had the president of Wachovia, or the CEO of Wachovia on, and how great things were, and they went from $9 a share to $1 a share in a week.
And then
he goes in and apologizes on John, whatever that comedian show is.
Jon Stewart.
Yeah. Remember he went on his show, but he had him on there saying, folks, this is the man, this is the man. And there's certain times that I get some good information from Kramer. I get good information. They do talk a lot about the trees, but you just must look beyond the trees into the forest. But being human, we all come back and, oh, yes, that makes sense. It should take off. Well, and we forget our logic.
Talking about looking beyond the trees into the forest, the media was 24/7 about this debt deal, and what was going on in the background, the forest, if you will, was the fundamentals. GDP numbers came out, were revised down. Last quarter was revised down to 0.4% growth.
Right.
The first quarter GDP was revised down to 1.5, I think. Folks, that's anemic, and I'll bet you, anything that we're going to see probably a negative quarter this quarter.
Oh, no doubt.
And who knows? They might even revise the second quarter negative. I mean, it's not that far from 0.4 to negative. And if that happens, that's recession.
Well, and what we're talking about is someone does go to the sidelines with this. And if you go to the sidelines, you still want to keep your eye open because that's what Wall Street's also looking for, the opposite side. When everybody thinks it's over, it's going to tank now, they'll take off again too. And you got to watch them because that's when they buy. So, it's just like programs that we use. It's just watch the institutions, but you cannot pull your mind from it. You gotta follow the rules. You cannot break the rules as bad as you want to. And because we watch a lot of financial news networks and all, just to kind of get their opinion, see who's in line and whatnot. They are excellent at working on the psyche, and they did it this time. They really did it. And you 100% must follow the charts. You can't break off the charts. You can't. I mean, and it's easy to do, and it happens. But we have an opportunity for a pivot here. We do have be on the lookout for a decent little rally. But that being said, they also, if they think that the majority of Americans are thinking a little bit of a rally, or thinking any kind of a rally, they could take this thing down deeper. So be careful there as well. Let that rally begin. You got to let that trend start. You got to let that pivot, as you talk about, Doug, happen. And go into that a little bit, about where you think that may happen.
Well, it could happen as early as Monday. And a pivot low is what you're talking about. And basically what that means is we get an up day on Monday, which goes above the closing high on Friday's candle. Now, Friday's candle was it was a doji. It was the mother of all dojis, which basically, folks, it means that the market moved a long way Friday, both up and down, and basically almost finished right where it started. So it was a complete and total day of chaos and indecision amongst traders. So Monday, if it opens up, and I'm sure, they're going to see the president have a talk, and probably Bernanke and Geithner will come out and say, everything's okay, it's cool, and, just to try to
but usually when they talk, watch out. Every time they've ever spoke, it kind of dips down a little bit. But the fact of the matter is, folks, you don't look at your money in pieces and parcels. You look at it holistically. And that's pretty much what we're trying to get across to you. This is just a piece of your future pie, if you will, your future retirement. And you look at your entire retirement, your savings as a whole, and say, all right, I have got to get some certainty put in here. And this couldn't be a better argument for certainty. Hedge yourself with certainty. We talk about different things like indexed annuities. There's other product out there as well, managed properly. But we look at it from a holistic standpoint, Doug and I, Paul. And basically, in a nutshell, if you have too much in the market relative to your age, I mean, you're going to commit financial suicide at some point. This market is a bear market. It is a bear secular market. Doesn't mean it won't have rallies. It will have rallies. But this government has been propping it up. And something else. I mean, we have got to get back to jobs, and real estate has got to turn around, Doug. And until those things really turn around, our economy doesn't have any footing. It has no base. Jobs have got to turn around. That's the only thing that's going to sustain this economy, sustain this market. The market, when it was running up, did not mirror the jobs in the housing market.
No, it didn't. And long-term listeners of this show know that we've been telling them that this market's been built on a house of cards, and it has. It's been built on government printing money and quantitative easing. You're going to hear people talk about, well, the PE is so low. Well, what they're talking about, folks, is the price-to-earnings ratio, and it's a forward-looking measurement. Well, let me tell you something. Those estimates can be revised down, too.
Absolutely.
And what looks like a cheap PE of 13 for the market right now may be a very expensive PE of 25 or 30. If companies stop making earnings like they have in the past.
The biggest thing the government has to do is give clarity to the corporations. They're sitting on trillions of dollars of cash. Well, they want to spend and they want to grow, but they're not going to grow in an environment where they cannot see the target. Only government does that because they can print money. Corporations can't print money. Now, I'm not big on, clearly there's a lot of big corporations that have their hands in politicians' pockets, which is a bad thing, but the politician still chooses to work with them. But the bottom line is, this government has got to give us clarity on, all right, here's your financial situation when it comes to taxes. They just must do it and quit this moving the pendulum all over the place, or no one's going to have confidence in this market. You're listening to the Wealth Guardian Show. We'll be back in just a little bit.